welcome to all the panelists here. We have a very elite panel, and as you can see, people from different parts of the payments ecosystem. You all heard the FM speak in the morning, and just before this session, you heard Dilip speak about payments part of it. Digitization has been the focus agenda for India for the last many years, and digital payments has been the bedrock driving the entire digitization agenda. Payments, which used to be an adjunct service offered by banks, has kind of now become mainstream, standalone industry, if you will. A lot of innovation there, a lot of growth there, a lot of new business models, market practices, and therefore multiple constructs that have come up. Against such a background, even the regulatory landscape has evolved to kind of bring in appropriate structures to create safeguards against any market risks. So a lot of development. This is a key point within the payment industry itself. In terms of timing, we are at, I think, a significant point of inflection. There has been tremendous growth, and as you heard in the previous sessions, we are even poised for a 5-10x growth from here on. Against this background, will this panel try to address some of the key drivers of the space and some of the key aspects in how innovation is driving it, and also, most importantly, how are regulators looking at the space, and what should we perhaps expect from a regulatory evolution perspective. So with that background, let me just start off, sir. Mr. Gunveer Singh, I'll start with you first. You've recently taken charge in DPSS, and at a very interesting time for the industry. And I guess over the last couple of months, you've had some interactions with various parts of the ecosystem. So my first question to you is, just as a broad brush view, what do you think of the fintech space, and what do you think of the participants?
Thank you, Vasu, and thank you for inviting me for this panel. And now, I will start with a caveat that, this is going to be my personal views. Whatever I say, it cannot be taken as official or, institutional views. With that caveat, yeah, I have joined recently, and for me, it's a very wide and dynamic field, with lots of innovations taking place around, in India and across the world. And, for a regulator, it becomes difficult sometimes to keep pace with all the innovations that are happening around. For the timely and the appropriate regulatory actions, because as a regulator, one needs to be aware as to what is happening in, your domain, and you need to be prepared as to, whether it warrants any action at some point of time, positive, negative, constraining. Given the pace, given the resources we have, sometimes, as I say, it becomes difficult for us. Industry participants, they come in all kind of sizes, small, big, established, new, with their own kind of governance structures, with their own kind of complexity of operations. And on top of that, not all the functions and the activities, they are under the direct regulation so far. So the payment industry is one such industry, which is, a lot of activities are still outside the direct regulatory, ambit. Whether you call it even the offline PS, the physical POS PS, the cross-border PS, we call OPGSP, they are still kind of, we are considering whether to bring them under regulation. Then the regulated entities, they engage in activities which are not regulated. I mean, the entities which have been given the license, they are authorized to do the other activities. Now, even the size of that, what is the size of the regulated activity versus the size of, the unregulated activities, all that happens. Then it's a question of number of players, which is an on-tap licensing. It's not a finite field. People can come in and all that. I think that is where it is as far as, what my impression is to begin with.
Very interesting. I think there are a couple of pointers that I'll pick up later that you spoke of in terms of the kind of players who play the space. But Sandeep, I'll just come to you, which is a slightly different perspective that I wish you can offer the audience here. You sit as part of a network, and globally networks sit smack in the middle of the payments flow. Importantly, in the role that you have, you get to see evolution of payments, not just in India, but across the world. Evolution both in terms of market participants and regulation. we'll address the regulation bit a bit later, maybe into the conversation, but just a broad view of what are you seeing happening in fintech space across the region, if you will, and any key insights from a India fintech perspective that you have as a network.
So thanks, Vasu, and good morning, everyone. Also, good morning to my co-panelists, Mr. Gunveer Singh and good friend Harshil here. So Vasu, look, I think first and foremost, I must start by saying that a combination of government, regulator, and ecosystem participants has driven unprecedented growth in the growth and evolution of democratization of digital payments in India over the last few years. And obviously, aided by a bunch of things, but a true inflection point post-COVID, which also saw really widespread adoption of digital payments. And the stats and all are out there. There's a lot of talk about it, so I don't want to go into that. But I think we should not forget that India continues to offer a very, very significant cash displacement opportunity. So despite everything that we have seen, only about 30 to 35% of India's personal consumption expenditure of roughly $2 trillion actually happens through digital means, and the rest of it is still largely cash, check, and other sort of non-digital forms. So we have a huge runway, a huge opportunity ahead of us. And I'll come to fintechs in a minute. The second thing is what UPI has done for democratization of digital payments. There's still a task ahead of us, and I think the earlier conversation touched upon that in terms of democratization of credit. We're still a country where access to credit, and it doesn't matter whether it's through credit cards or any other means, but access to credit, there is a gap of about 100, 150 million, doesn't matter what that number is, but a very large section of the population doesn't have access to affordable and responsible credit. And we still, all of us, government, regulator, ecosystem, fintechs, have a huge role to play in democratizing credit. The third sort of pillar that I see important is that we've seen a lot of innovation in the area of consumer payments, but there are huge flows domestically in terms of government flows, in terms of business-to-business flows, in the cross-border context, both inbound and outbound remittances, which can be digitized further. And even if it is digital, it is not necessarily as frictionless and convenient and affordable as it ought to be. And that's also something that happens to be even a focal point at the G20, et cetera. Just the evolution of cross-border remittances. And then, on top of all of this, I would say that the Indian market has some distance to cover in terms of, I would say, mobile contactless payments. If any of you have traveled to UK, Singapore, Australia, Hong Kong, the whole experience of contactless payments, which is, mobile tap and pay, card tap and pay, contactless acceptance, takes payments and digital payments to an entirely new level in terms of security, convenience, and elimination of any form of friction. So it's a great story thus far, but significant opportunity for growth and evolution on cash displacement, business to business and government flows, cross-border remittances, contactless payments. And I think all of this will require fintechs to play a very, very significant role alongside traditional financial institutions, government regulator, networks like us, to make all of this happen in the next 5 years.
Very interesting, Sandeep. So we'll pick up on the contactless part and what else we could do in this country in subsequent questions. But Harshil, let me come to you. We've heard a regulator, so to speak, from RBI speak, and we've heard a network speak. But you are the guy on the ground who's building the businesses, and you built an amazing scale business in a very short period of time. To the point Sandeep made, the pandemic provided a step function growth for payments as a business. I think in the audience, you have a set of founders and very early stage companies too. So it would help if you could kind of give us an overview of how did you scale up your business, right? We've all heard of the great opportunity India has and how fintech is a booming space. Just walk us through how did you leverage the last couple of years? How did you innovate on product or on process? And any challenges along the way which can...
Yeah. So Vasu, as we started a company about 8 years back, and over the years we have been continuously building products that help solve various problems. I think, and you're right, there are 2 or 3 step functions that happened through the journey. First was demonetization that happened in 2016, and then the COVID wave that came in. And I think the only role that players like us had to do in a situation like COVID is to try to find problems that you can solve. And there were a lot of creeping problems coming up to an average business owner at that point of time that we were the best place to solve it. So we launched multiple host of products during, especially during the COVID period, just by talking to our customers that, hey, there were a lot of customers who wanted to accept digital payments suddenly. They didn't have a website or an app, so we launched link-based payments. We spoke to a lot of customers who said that I don't have a tech team, I want to go live tomorrow. So we launched payment pages, so you could run your payment systems through Razorpay, so on and so forth. But the idea of scaling up on payments is all about innovation, and especially product and tech innovation. And this is one thing that we felt, at least when we came in, is one area where we felt that the payment systems, while they were good rails for building payment systems, and India has some of the best rails, we heard Dilip talk about UPI, there's still a lot of opportunity to build product innovation on top of it. When you speak to an average customer, there's still a lot of challenges beyond the pure payment acceptance that he's not yet solved. And like Sandeep spoke about that, while we've solved some aspect of that flow by enabling P2P and P2M payments in the simplest fashion, when you go into more deeper challenges, like say if you want to do a B2B payment, you want to do reconciliation around it, when you want to do B2G payment and you want to do tax filings and compliances around it, and so on and so forth, there's still a lot of problems and challenges that are completely unsolved for. And like we continue to look at that, and the best way to look at that is go to an average customer. Like if we are B2B, so we go to an average business and ask what kind of payment flows are you doing on a daily basis, and how much of that is digitized. And it's not surprising to know that hardly 4 or 5% of it is digitized. When you speak to even some of the largest enterprises, while their collections might be completely digitized through UPI and other modes now, the back-end process after collections is completely going through cash, check, physical means. And there's a lot of opportunity to scale up there. And those are the areas that keep fintechs like us awake on figuring out how can we go on tomorrow and solve those problems and scale up there. And if you look at add it all together, then what Dilip said in the last session, like scaling up from here to 10x or 15x doesn't seem very hard because there are 10 times more opportunities in those kind of payments than what we have solved today. And I think that is where the next wave of fintech innovation will come in. And this is not just limited to payments, right? Like payments is a starting step. When you do smooth and seamless access to payments, then credit becomes the next enabling step that, okay, now you can predict and look at the flows and give early access to credit to make those payments happen. Wealth is a third aspect which is happening in the fintech space, that now that you know how much a business typically stores with them, can you provide wealth products around it? And cross-border is another area where a lot of businesses, while they accept digital payments through in the domestic channel, the cross-border acceptance is still not completely solved for. So there's so many areas that keep opening up. The best way to build around it is to keep yourself in the minds of a business owner and see what all is he typically doing with his money.
Let me just pick up something you said and ask you a thing. I think even in the morning session we heard that a large part of the growth in payments is coming from fintechs as opposed to banks. And I heard an amazing statistic that 93% of all UPI is from fintechs. Harshil, from ground perspective, why do you think that's happening? Why are fintechs winning that?
So first of all, I don't agree with the statistics. Like 93% of payments goes through fintech, but at the end of the day, everything hits the bank. So it's impossible for a payment flow to complete without hitting the bank, right? And I think as fintechs, we would love to take all the credit for it. I think a lot of credit goes to the banks who are building the base rails, on top of which we are building innovation. So I think everyone has their own role. Right from day one, we have worked with various banks in building the products that we have. And every product that we have out today, there is a banking partner who has played a role in enabling us and supporting us in that, without which I don't think just our product innovation itself could stand on its own. So I think there's definitely an area of expertise that banks typically have. Like the base payment flows, the base management of money flows, the base management of treasury and things like that, that I don't think fintechs can replace. But there's definitely an advantage that fintechs have in building the end customer experience, the end product experience. That is something where fintechs are able to shine a lot on. And I think those are the roles that each of us will continue to play. I think the Indian payment ecosystem is quite big, that every stakeholder can make enough money and can make enough economics around it if we can all grow the pie together. And that's what happened in the last 4 or 5 years. We'll see a lot of that continue to happen, but it will only happen when both of us realize that, okay, we have to work together to take it to the next level. Like, I think we can compete, and we'll continue to compete here and there in a little bit of, in small ways. But when you step out and look at the larger picture, both of us, and including the regulators and banks and fintechs, are working together to grow the pie.
So, sir, I'll come back to you from, again, picking on what you said earlier and what Harshil just added. And I'll come to the topic of payment aggregators, because a lot of the payments growth has been delivered in the market by players who are typically called payment aggregators. These are a set of players who were historically had a light touch regulation on them in terms of just the money flows. And a couple of years ago, fresh regulation framework was put into place to regulate PAs through some kind of a licensing or authorized regime. It's in the public domain that RBI has received over 150 plus applications, and they're being perused in terms of seeing who gets to be eligible. But within this set of people who now want to play in the fintech space, and largely driven also by the growing attraction of the place, you have a combination of players who are pure play fintech in terms of payments, people who want to do payments plus in terms of lending and payments, etc. You also have conglomerates who want to become payment aggregators because they think there is value in it. And you also have merchants who think they need to become their own payment aggregators. So structurally, with the bar for entry into the space being what it is, you'll end up perhaps with a space which has all these kind of players that will in turn drive different models, different risks. From a regulatory perspective, just two insights that if you could present. One, how do you view this number of players, 175, 180, which is perhaps the largest number of applicants from any regulated service perspective? How do you see it kind of playing out in the market? And in general, for many of these players, some of them would be small, big, like you earlier mentioned. Compliance is going to be something that's new to them. So your first set of thoughts on how should players think of compliance as they get into it, but more importantly, first, how do you see the large number of players and them impacting the space?
Yeah, so I mentioned about the number of players. I think it's a matter of record that, so far we have given the in-principle authorization to about 59 such entities, but no entity has been given the final approval. Now, that is a different matter, and in time, I'm sure the final approvals will come by, and it shouldn't be too long. Regarding the number of players, that's a difficult question. That's a difficult subject, it can be seen in the context of innovation versus the compliance. You have the larger players who will be much more compliant, and by that definition, the ability to innovate can be perhaps a little bit constrained, and because you have achieved that size. And compared to that, if you are a startup, if you are a new player who's kind of thinking of innovating, coming up with different disruptive solutions, your focus may not be on compliance. So as a regulator, it's a difficult call to take, and we are kind of looking at the subject. I don't have a clear answer, as to what is the number of players. I mentioned at the beginning also the on-tap licensing part, that, on-tap licensing is there, which means that the field is open as of now, okay? Now, depending on the call that is taken, which is a difficult one, the question will be answered in due time, yeah? On your second question about, the compliance regime, again, there is a flow from the first question itself, that it's a question of, when you start small, you have a, small size, you are young and you are ambitious, and you are inexperienced also. And the compliance is not really the first priority. But compliance is not only for the purpose of compliance. It's, I would take it as, your moral and ethical responsibility to your own stakeholders also, okay? Because, and then in time, when the business becomes big, when, with size, you cannot grow beyond a point without being fully compliant. And when you're kind of doing business for a couple of years, and if there is a history of you being non-compliant, you kind of build a reputation. And that does matter to the regulator also as to what has been your history. So I think, all in all, you need to, maintain a balance. And I think compliance has to be on your first priority, that, you cannot really start a business without understanding as to what are the compliance requirements, going forward.
Because of what he said, Harshil, I'm just going to come to you before I go back to Sandeep on a larger question. And this is more for you to answer from an entrepreneur's perspective, not necessarily Razorpay itself. When founders or entrepreneurs start business in fintech, is it typically top of their mind that compliance is as important as, let's say, product or a market?
So I think if you're building in the fintech space, and let me speak both from regulated and non-regulated perspective, I don't think compliance is a choice. There are, even when you're in a non-regulated space, there are still a lot of requirements, let's say for payment aggregators, even when we are not regulated, there are a lot of requirements from networks, from banks, from various other players that you have to form some basic set of compliance function and have a basic set of compliances followed. Otherwise, you can't even get into the door, right? So whether the founders want it or not, I don't think it's a choice if you're in the fintech space. Now, coming to the regulated space, and to your point earlier on the number of applicants, and like Sir spoke, that there are a lot of people who don't understand the compliance aspect of it. I think in the regulated space, it becomes even less of a matter of choice, right? Because once you have built up, even if you build up a small business, even if you're doing like 10 transactions, when an audit happens, you can't say that just because we are doing 10 transactions, we chose to ignore the compliance set. So I think over time, founders are learning that part, that if you're entering the fintech space right on day one, first of all, it's important for you to learn how to handle compliance, at least in the basic fashion. And if you're in the regulated space, then it has to be top of mind. Because in the regulated space, you don't even have the ability to go around and say, okay, our scale is small, so we didn't look at it. Because the rules are same. The rules and standards that are applied are same, whether you're a large company or a small company. Of course, the larger companies will have even tighter rules to follow. But even if you're a small company, there is a basic set of rules that you have to follow, and you have to demonstrate your ability to follow it consistently. And like Sir spoke about, that if you miss it in the early days, it becomes harder and harder to catch that bus, because once the business starts expanding, and most fintechs want to expand exponentially, once you start expanding exponentially, it becomes harder and harder. It's like running behind a bus that's speeding up constantly, and it becomes harder and harder to get there before something goes out of the window. So it's important to get there early on, and even though it might be a little hard, it might feel to a founder it is a little distracting. I think in long term, it becomes more and more important as you scale up to a larger size.
I think those are very important insights for people who are just starting off business in the fintech space. You heard Harshil speak about the importance of it. So yeah, make that your number one priority on par with other aspects of your business. Sandeep, coming to you, you're obviously in a different zone in terms of being a network. But even in India, over the last few years, there's been a lot of, compliance asks of not just the network, but the card chain as a whole, right? Starting right from many years ago from a mandated 2FA to card tokenization to recurring payments to various other aspects. As a global platform who potentially has centralized ways of doing things, how have you navigated this space of the country-specific compliance asks, including data localization? What learnings and what insights can you present to the audience from that?
So first of all, when you operate across multiple geographies, if you are a regulated entity in a geography, compliance is a non-negotiable, and you have to comply with local regulations. They take precedence over any kind of global construct, structure, operating model that you may have. So if India, for example, mandates two-factor of authentication, data localization, card-on-file tokenization, these are all things that is very much integral to doing business in the market, because we are answerable to the RBI first and foremost, and after that we have to manage our global ecosystem. So that's a pretty clear thing. The second thing I would say, and we really appreciate the fact that over a period of time, the regulator has been very consultative in approaching some of the big regulatory changes. So, from the time that data localization was announced to the time that it was actually implemented, it was a journey. And it was an extremely consultative process because one had to understand what the regulator wanted to ensure through localization, and only then could we as Visa go back and say, yes, we are going to ensure what you really want. I mean, you know, because there are many interpretations of what constitutes data localization. Similarly, we have discussions with Mr. Singh and his department today on variety of topics, including, you know, processing domestically versus processing offshore, et cetera, et cetera. So, you know, it's a consultative process, and that is truly appreciated because then both parties understand what is required, how long it will take, and what constitutes or construes full-blown compliance to what is being sought. One shouldn't also assume that, you know, everything that's happening in terms of regulation is a challenge. Some of these have huge benefits, and let me just take card-on-file tokenization. So India embarked on this about a year ago, and, you know, a lot of people were amazed to hear that just as a network, Visa has done well over 300 million, you know, tokens, created that for credit cards. And that is 5% of the global number. And we operate in 200 countries, and in some countries, COF tokenization has existed for quite a period of time. So for us to become kind of the third largest market globally from a card-on-file tokenization perspective, 65% of transactions today actually happen through the COF token route, and about 35% through guest checkout. So, you know, that's a great thing. And guess what? While we complied with tokenization because the intent was security, but one of the benefits of consumers tokenizing their cards with merchants and or on devices is that we see 5% higher payment success rate for tokenized cards. Now, we've got to make guest checkout equally seamless and friction-free, and that's work in process along with the regulator and ecosystem participants. But it's not that, you know, regulations and compliances are not good. They're actually great for the ecosystem if implemented in a consultative and thoughtful manner. And equally, you know, like, we are very proud of two-factor authentication, and rightly so, but we should also realize that, you know, the short messaging system was not invented for regulatory compliance. It was invented for very different reasons. And so perhaps the time has come to think about whether an OTP coming on SMS is the, you know, the ultimate form of authentication and security, and or has the time come for us to think more about biometric, retina scans, tokens, or other forms of security, because the world has moved on. And you know, the authorities in Singapore, for example, have moved away from SMS as an authentication mode as of June this year. So again, we as a global network owe it to the market, our regulator, and the ecosystem to bring some of these new thinking into where does regulations, etc., need to be kind of evolved with the passage of time.
So, yeah. So let me respond to you, you know, on the points that you're making. Somehow I missed saying it in the beginning, and you know, the way I look at regulation and you know, the industry, I mean, we are essentially playing a complementary role. Okay, it's not that we are on two different sides. You know, without regulation, you know, the industry cannot exist, and you know, without industry, regulation has no meaning. So we have to complement each other. We have to work together. So when we are talking of a consultative role, I mean, I don't think there is any other way. And you know, this is a good progress that has been made, you know, I think across the country. And of course, as a part of the department and RBI, that will be, you know, continued. And another thing which I wanted to also highlight from a regulator's perspective, that the very, I think the core idea of regulation, you know, by kind of maybe emphasizing on the safety and security and customer centricity, is to build trust in the system so that, you know, the customers have faith in, you know, the institutions, in the processes, and the products which are offered by the regulated entities. So that is, you know, another which is a value-added thing for the industry that I look at, from the regulation. So I, personally don't look at regulation as something which is constructive or negative, but it is more, a complementary role for the industry. Just wanted to add that.
I want to thank Sandeep because oftentimes whenever there have been regulatory guidelines, typically I think one of the feedback we've always had from the RBI is the market reacts to what's lacking in the regulation, what's been a problem to implement or what's not, and that's got played up. But I think Sandeep's put out some statistics to say how some of there's been increase in efficiency. So I think that's a great input for everyone to have here. In a similar line of business that we handle for recurring payments, we've also seen, despite the initial kind of critique in the marketplace around it, a phenomenal amount of growth in the payments there and the virtually zero complaints kind of a mode. So I think there have been some regulation that's been extremely helpful in terms of growing both the market and the quality of the business that happens there. In a last question, sir, on sticking into this broader area of compliance, just one part of it. One of the things that has been debated a lot, spoken a lot, is the angle around KYC. In the early sessions too, I think when Dilip spoke of the next phase of growth being in the credit side and huge growth in payments, I think this is one issue that's been addressed often enough with regulator, but I just want to make a kind of draw an observation and get your views on it. Historically, the KYC guidelines were drawn keeping banks in mind, in a historical sense, where essentially these were entities that had an account-based relationship with the customer, whether by way of deposit or lending. You have most of the fintech sector, which now typically operates on a non-account-based relationship. They're either intermediaries or assisting in the process. But a lot of the KYC guidelines do kind of get regulatorily applied to them, and there have been different interpretations on the degree of responsibilities various kind of players need to take up. So just wanted, I know there's a regulation place and the guidelines are clear, so beyond that, but just as your take on how should entities that are dealing with account-based relationships think of KYC versus intermediaries? Did you see a difference in the kind of role they need to play when they're dealing with a customer? More specifically, I think I address it from the merchant space. The customer side is fairly well discovered in terms of what is needed, there have been advancement. But in merchants where people will go on to lend or otherwise deal with them, on a non-account-based relationship angle, what are your thoughts there?
So if I get it right, I think the question is in the context of the payment aggregators, right? And, it's, for me, it's a matter of, interpretation, whether, the relationship that the PAs have with the merchants, whether that is account-based or not, okay? So, because, you do maintain accounts with them and you do settle them, maybe at the end of the day, you do reconcile with them. So to say that that is not an account-based relation, that has its own interpretations, but be whatever as it may be. The KYC regulations, which are actually the domain of, the Department of Regulation within RPI, which we also follow, and it's a legal requirement. There can be a few flexibilities here and there, but more or less they have to be followed in totality. And one of the key things within the KYC regulation is that they are applicable on transaction-based relations also. So even if you are carrying out a single transaction, I think beyond a particular point, the KYC is required. And the way the industry is structured as of now, the PAs and the banks, there is some degree of uncertainty. And we are looking at it as to how we can bring more clarity onto that. But I think I have shared my thoughts, as to how we are looking at it. I mean, with the caveat again that it's my personal opinion as of now. When it comes in writing as a matter of rule, then it becomes institutional.
Very useful to hear that. I'm sure we'll all be able to work from the industry perspective to get to the right aspects of knowing the customer. So Harshil, let me come to you on a key aspect of what was talked about in the morning and basis all this, is of sustainability. Fintech is a broad space. The models are still being discovered, new business models and people operate. But payments is what we're speaking about. And as I said, we'll still have to await the final number of licenses. But if you look at the number of market participants today, which is close to 170 plus, and that's not counting the banks, which traditionally are the strong players within the payment segment, so to speak. That's one aspect. And then you have the biggest driver of payments, UPI, which, as per the recent last month's data of RBI, constitutes almost 60% of the retail customer digital payments. And that's a non-chargeable service, both either directly or indirectly. How do you read all this into the, let's say, the sustainability or viability of the sector, purely from a payments perspective? I get it that if payment players innovate to areas other than payments, you can monetize alternatively. But from purely a payment sector perspective, how do you look at sustainability and viability?
Yeah, see, even 4 or 5 years back, even before UPI and everything, payments was always a low margin space. And I think it continues to be that. And simply because the base payment rail will continue to get commoditized. And there's no doubt about it that just if you're providing a pure payment rail itself, it will continue to get commoditized and the margins will continue to shrink. So it's a race to bottom, and that's why it continues to have very, very low margins. There are only two ways to make money in payments. One is to have a very, very significant scale, which is what, let's say, like banks or some of the largest players would have, where you have such significant scale that even the small, thin margin adds up to a significant volume. That's one way to make money. That's what a lot of players have tried in the last 5-7 years, including us, to get significant scale where the small margin adds up. The other way is to build differentiated products. And while that might not monetize the core payment rail, the core payment rail becomes the channel through which these other products are sold. Now, one example of that is credit, which a lot of consumer side companies are adopting, which has its own nuance because while credit makes a lot of money in the short to medium term, it's a highly risky business and you need to have the understanding and the depth to scale it up. But speaking from our perspective, at least the way I feel about it is that there are a lot of opportunities to build products and services on top of payments. And I'm talking about non-credit, like software-based services, things around reconciliation, things around doing disbursements, things around managing other form of money flows. I think those becomes, and a lot of those areas can make a significant amount of money because those are typically like SaaS businesses. The role payments plays in that is payments becomes a foot in the door through which you get into a business, through which the core relationship is established, and then you build the relationship, the depth of the relationship towards other products and other services on top of it, which end up making us a little bit more amount of money than, let's say, the core payment stack. The difference is that none of these services will be as broad-based as payments is. So the scale of payments is always much, much higher. And that's where coming back to your question around the number of licenses, while it's great that a lot of players are applying to it, I hope the players realize that payments is a business by itself makes money only at scale. So unlike lending and a lot of other businesses where you can be a small player serving a small segment and make decent amount of money, payments is not that kind of business where you can serve a small customer base of, let's say, 100, 200, 2,000, do 10, $20 million of volume through you and make a decent amount of money. So by default, a lot of those businesses will not be sustainable. I believe there are two reasons why a lot of players are applying for those licenses. One is there is this general frenzy that, hey, we should have the license. Maybe tomorrow more things will open up for this license and they want to have it. The second thing is that a lot of players feel that they can build a lot of things on top of payments, which is coming to my second point on the monetization, that they feel that, for example, if I'm a food delivery app, if I have my own payment system, I can enable restaurant-based payment systems, I can do payment systems for grocery stores and stuff like that. So there are a lot of companies that are taking up that license for the expectation that they can innovate on top of that license and create specialized products and services for a certain segment which can still hit meaningful scale. But the only way money would be made is at a lot of scale. Even the additional products and services piece adds up only when you have significant scale to plug in those. By default, I don't think small players in the payment space end up making a lot of money.
I think that goes back to the point Mr. Gunveer Singh made earlier in his first comment to say that lots of players are building models which have partly regulated businesses and kind of SaaS businesses that might tend to be unregulated. And we have to see how that kind of mixing of businesses plays out. So shifting gears from compliance, Sandeep, again, I said, since you have a view of markets around the world, India has been a market where payments have grown significantly on the back of QR. Just tell us, how can cards and QR coexist, and what can be done together in a cards QR partnership that grows the Indian digital payments market faster?
That's a fabulous question, Vasu. I get asked that all the time. So number one, I started off by saying that India still has a significant cash displacement opportunity. So we are absolutely convinced about the fact that cards and QR will coexist, can coexist, must coexist in India. Number one. Number two, let's also understand that while QR-based payments have grown perhaps at 60%, the growth of credit card payment volumes is also not small. In the last 3 years, we have seen payment volume growth of credit cards at about 45 to 50% CAGR. The transaction growth is a bit lower because some of this PV growth is fueled by increase in average ticket size. But so let's put it in a very simplistic way. Card payments have grown in 5 years at 3x. QR payments have grown at 7 or 8x. So clearly, relatively, cards have grown slower than QR, but it's not that cards have not grown, particularly credit card payments. Then let me come to the point of resilience in an ecosystem. So why do cards need to continue to have a role, apart from the fact that cards come with rewards, a very, very well-developed dispute resolution mechanism, fraud management mechanism, which, QR has a long distance to travel. Cards have been around for 50, 60 years, and the entire sort of dispute, risk management, fraud management, chargeback, refunds mechanism that is there on cards is not there on QR. So for specific ticket sizes, specific use cases, cards have an incredibly important role to play. And I'm not talking just about the cashback and the airline lounge and the golf and some of those other, rewards. So that's important. Plus, we have all experienced times when a QR payment doesn't go through. So why would you not have a debit card, a credit card as a fallback option if you're trying to make a payment? So we again say that for a digital payment infrastructure, resilience is important, alternatives are important, choices are important. And for a country of 1.4 billion people, as large, as complex as India, why would you want to have a single point of failure, one option to consumers? You should, this thing. And the last thing I'd say, the day of a plastic or a metal card is not going to be there for the next 5, 10 years. So don't think of cards as merely the plastic or metal that you carry in your wallets or your handbags. The modern credential is a virtual credential which is running on a particular rail or platform. And in fact, we have introduced propositions in certain markets and hope to bring it to India soon, where with the same 16-digit credential, you can toggle between making a payment like a prepaid card or a debit card or a debit card with installments or a secured credit card or a credit card. And it's just the same PAN or 16-digit number. So I think, and then of course you've got mobile and contactless, which I talked about. Tap to pay, it is absolutely the most phenomenal consumer experience. People who experience the power of tap to pay don't go back to scan to pay. And you have to go around the world to see what has happened wherever tap to pay and contactless payments have proliferated. With higher security, lower friction. So again, you would expect me to bat very strongly for cards, but I think what I'm batting for is choices to consumers, alternative payment forms, elimination of friction with greater security, and fraud management, dispute management, risk management that comes with an evolved ecosystem. And if the plastic or the metal gives way to virtual credentials sitting on your phone or any other device, wearables, whatever it is, so be it.
Great answers, Sandeep. I know we're running out of time, but sir, I have one question of you before I don't know if you have time for audience questions, but one last question of you. Banks have always been regulated under a single license, so to speak, a banking license. Within payments, as the landscape has evolved, the regulators kind of issued guidelines, circulars to cover specific service aspects. There's often been discussion, and it started with prepaid, then payment aggregation, the bill payments. There have often been conversations about has the non-bank space, non-bank, non-lending space evolved to a level where it makes sense to look at a slightly different licensing regime. Do you think do you think it's time, or are there any line of thought that the regulator has to say, can we now issue a unified license under the PSSA instead of each service or activity-wise licenses?
So the regulations for each activity will be separate, right? So there is no debate on that. The regulation will be activity-wise, but what you're talking is that, the authorization, whether that can be for the entity, and once an entity has been authorized, whether they can, they don't really need a separate authorization for different activity.
Right.
Now, that is something that we have started debating within, our department and the bank. So we have started the process already in terms of, looking at it, debating it, examining it. But let's see what the outcome is.
I think that's wonderful news. You can see Harshil already beaming from the other end of the table. So yes, I think we run out of time, but there might be time for a couple of questions from the audience if there are any. To the extreme right first, somebody can carry a mic there.
Thank you. My question is to Mr. Ghosh. You mentioned that contactless is a secure but frictionless method of payment. And we know how 2FA has been very close to Indians. So how, exactly is contactless secure without a second layer of authentication?
I could give you a number of examples, and you should come across to the Visa stall and we'll show you that. But very simply put, when you make a contactless payment using, let's say, for example, your phone, so don't think of contactless again as just tapping a card. It is secure even when you tap a card in a face-to-face environment. But when you use a phone, you authenticate through biometrics on your phone as well. So I just think it's a complete myth that, any kind of contactless payment is not secure. It is very, very secure. And again, if you think of fraud rates, when we introduce contactless payments, we look at complaints, frauds, we look at data and statistics from India, from across the globe, and there is enough and more data to prove that contactless payments are, as secure, if not more secure. And then, again, the thing is about giving people choices. So you can enable contactless if you're comfortable with it. You can disable it. That's how the regulations in India are constructed. But from a security aspect, we have data from across 200 countries that shows it is extremely secure.
Thank you.
Just one question here, and that will be the last question.
Yes.
Yeah. Right here in the front row here.
See, thanks, panelists, for the wonderful discussion. My one question is to Harshil. Harshil, how important you see operational risk in the aggregation business? Because when you are dealing with the merchant, with the KYC norms, with the STR filing, reporting, low margin business, huge volume, a slight slip on the operational risk can wipe out everything, So how important is for aggregation business? And one to Vasu, UPI, we say it's free, but if we say for the mighty incentive, I don't know how much it is being shared, but if you calculate, 2 to 3 bips is still can be earned in the, considering the mighty incentive. So UPI, though, it's not charged to customer, but government incentivize and players have 2 to 3 bips margin. It all depends how much banks retain, how much they give to fintech, that's a different thing, Thank you.
Before Harshil answer, let me address the second part. You know all the facts, you answered it yourself in terms of it being a subsidy for a limited period and how it value passes on the chain. But I'll let Harshil answer the first
Yeah, no, I think a very valid question, right? See, any business where you are in the business of moving money, there is significant amount of operational risk, and especially when you're part of the money flow itself, right? So if you're a pure technology player where the money doesn't flow through you, that part goes away. But when you're part of money flow, any small issue or error can lead to a significant amount of risk. Like if a tiny bug in the payment platform, somebody exploits it and it could amount to hundreds of crores. And I think a lot of players in the ecosystem have seen such things happen. I think the only way to solve it is to, and that's where when Sir spoke about compliance comes in. Well, compliance might look onerous when it just comes in. the purpose of a lot of these things that comes from compliance perspective, the reporting perspective, are essentially to make this thing a lot better to manage. Because sometimes in the focus of growth of business, you might consider that, okay, this might not happen, this will not happen to me, and when it happens in such a significant way, then the complete business can get wiped out. And it's not just in India, it's across the world. You have examples of companies like Wirecard, which were like massive at a certain point of time, and in some ways, a small issue wipes out the entire company, right? So I think at least from Razorpay perspective, I think what I can say is that there is a very strong set of operational practices that is needed, strong set of SOPs, strong set of guidelines that are needed. And at the end of the day, it's the culture that you have to build on the operational side of things that no matter what happens, compliance is priority. And as the business scales up, it doesn't even be a choice. You have to do that because you start seeing small leakages amount to such significant amount that the entire money that you've earned over the last 5 years, 10 years can get wiped off. So it's not a choice anymore. And that's why my earlier point to Vasu's question was that if you are in the business of moving money, you can't take compliance as a second thought or an afterthought. The issues will come in, and when they come in at scale, it will be far bigger than what you can imagine.
Thank you. We've absolutely run out of time. So on that note, we'll conclude this session. I thank all the panelists for a wonderful session and the audience for having heard us out patiently. Thank you.